Welcome back. We receive a ton of great comments, and we certainly appreciate all of them. And I wanted to take a little time to talk about one in particular that we found very interesting. Essentially, it says Investopedia, and this is in regards to the Federal Reserve video we put out just the other day. The Investopedia says about bear steepeners. It's a term that's used to describe when long-term rates rise faster than short-term rates. The term got its name because it tends to be bearish for equity markets, since rising long-term rates indicate inflation, future interest rates. Now, when we spoke with the FOMC meeting, indicated that the higher rates, the long-term maturity, the 10-year bond in particular, those rates are rising, that was an optimistic sign. But meanwhile, the bear steepener is a condition where it's actually considered to be bearish when long-term rates rise. So I thought it might be helpful to look at some historical charts and to try to get an idea about how the markets move, stock and bond markets move under different economic conditions. So on the left-hand side over here, we have the white line. That's the 1-year Treasury bond, the short-term bond. The red line is a 10-year bond. On the right-hand chart, the red line is the same 10-year bond. So the left and right red lines are the same 10-year bond. The yellow line over here, that's the S&P 500. Now we're taking this year by year. So this screen over here shows us the entire trading year for 2006. On the left-hand side, we can see what was happening. 2006, if you recall, the economy was quite strong. Both long and short-term bonds were going up. Now, just let's take a moment, step back, and identify why bonds go up. Now, this is a very basic sort of overview explanation. There are far smarter people out there and, asset management firms out there that spend a lot of money, a lot of time analyzing the fixed income market. This is meant to be just an overlook, so to speak. So the short-term bonds, like the 1-year bond, these are yields. They move and are most reactionary towards the anticipation of future interest rates and what may happen soon. The 1-year bond's going to go up if it's thought the Federal Reserve is going to raise rates soon. The 1-year bond's going to go down if it's thought the Federal Reserve is going to cut rates soon. The 1-year bond is reactive to the anticipation of future near-term interest rate decisions. The red line, the 10-year bond, is more of our long-term economic outlook. How do we think the economy is going to perform in the next several years, for example? So when we see both lines moving up, it's telling two different stories. The white line, the 1-year bond, is going up in anticipation of higher interest rates, which we knew that was the case in early 2006. Why not? The economy is very strong. The 10-year bond, the red line, was going up in anticipation of strong economies in the future. Things look great. The housing market's very strong. Well, this turned to the downside in mid '06. We can go back and look at the economic calendar and try to remember exactly what was happening at that time. But essentially, there was a shift in the bias, and the white line, the 1-year bond, started to go down very simply because the shift was okay. Economic numbers don't look so good. Federal Reserve may start cutting rates. Simultaneously, the long-term outlook started to deteriorate as well. Long-term economics may not look so good in the future. Right-hand side of the chart, we have the red line. That's the 10-year bond as well. It's the same turn, a turn for the worse in terms of the long-term outlook. The yellow line is the S&P 500. Now, the S&P 500, the stock market's a different situation. Bonds look at economics. Bonds look at jobs, non-farm payrolls, GDP, inflation, all those kind of things. It's looking for the strength of the economy. The stock market, the S&P 500, is the expectation of future corporate earnings. Of course, corporate earnings are affected by interest rates and economics. But, during bad economies, some stocks do some companies do very well. And during good economies, some companies go out of business. So the stock market is a little bit, it's disconnected from the bond market. It's linked to the anticipation of future corporate earnings. So in 2006, the outlook for corporate earnings, it was still quite good. Let's go to 2007. Left-hand side. The Federal Reserve is now actively looking to cut interest rates, and that's why the white line, the 1-year bond, went down. The red line continued to travel lower, Very simply, the long-term outlook for the economy was getting worse. People were starting to talk about the housing market. They were starting to talk about, these credit derivative swaps and things like this. Right-hand side of the chart, well, the 10-year bond, of course, we know is going down. The stock market started to waver. Some analysts out there said, well, I'm looking at the bond market, I'm looking at the jobs numbers. Things don't look great. They look okay. And that's why we moved into kind of a choppy market over here. 2008, left-hand chart. The economy looks very bad. Federal Reserve actively cutting interest rates. One-year bond is really going down fast. Again, go back to the prior chart. The one-year bond in 2007 went from 5% to 3%. In '08, it went from 325 to basically zero. The 10-year bond also by the same token also went down a lot, and really at the end of 2008 that was the stock market crash and the bond market really followed. The 10-year bond, if you're looking for a bond, the yield that moves closest to the stock market, generally speaking, it's thought that the 10-year bond yield is most closely linked and related to the S&P 500. Again, stocks move in anticipation of future corporate earnings. Bond yields move in anticipation. Long-term bond yields move in anticipation of future economics. So we see both of these lines move down very, very quickly. 2009, we hit a bottom in the stock market. That's on the right-hand side. The yellow line starts to go up. The white line is flat, and we're going to stay flat for a long time. Remember, the one-year bond is the anticipation of future interest rates. In 2009, was it thought that the Federal Reserve is going to raise rates? No way. They're saying we're keeping rates low for a long time, and that's why this white line stays low for a long time. Well, with very low interest rates and all of that stimulus, the 10-year bond yield starts to rally from 225 to about 375 over the course of 2009. And the stock market likes that. The stock market looks at the bonds and it looks at future corporate earnings, says things starting to look better. I think the worst is behind us. 2010, low interest rates, and then we start to see a little bit of a depreciating bond market. Now, we don't know. We have to go back and look at the economic calendar, see exactly why the 10-year bond was selling off. But the fact of the matter is, look at the interest rates. There's zero interest rates. Even with any kind of blip in economics, as long as we have zero interest rates, we're borrowing money basically for free. And that's why the stock market really started to waver in 2010. We had that flash crash, if you recall, but then it went back up. So maybe the takeaway from this is if we ever find ourselves again in a condition where we have zero interest rates, we want to buy on weakness. We want to buy the stocks as they come down because with low interest rates, they'll eventually go back up. And with the bond market, when the yields start to go down on the 10-year, they will go back up. So if you see yields go down, which means the bond price goes up. Remember, bond prices and yields move in opposite directions. We want to short the 10-year bond because eventually we know with a low interest rate, zero interest rate policy, those 10-year bond yields will eventually go back up. 2011, low interest rates. Okay, well, that's all we need to know. 10-year bond yield is coming down. Stock market is still kind of wavering in 2011. But the fact of the matter is, we know with zero interest rates, what goes down eventually will go back up. And go back up it did in 2012. Again, low interest rates, the bond market starts to get a little bit of a bid over here. Well, the yields do. The stock market gets a little bit of a bid. We go from 1250 on the lows up to as high as 1450 S&P 500 in 2012. Now we have 2013, low interest rates and 160 yield low on the 10-year bond goes up to about 3%. Bond yields almost doubled in 2013. That's the 10-year bond. The stock market started 2013 at 1400 S&P 500, ended up near 1900. That's about 25%. Not a bad year for the S&P 500, 2013. Again, as long as we see the one-year bond near these lows, that's all we really need to know. Well, that was the case, and the one-year bond through 2014 remained at low until the end. We start to see a little bit of a blip in yield. What's this telling us? There's an anticipation Not a certainty, but there's a little bit of anticipation that the Federal Reserve may start to raise rates. That's how good the economy looks. There's a little bit of inflation. Well, we saw some blips along the way, but the S&P 500 hit lows of 1750 and closed the year near 2100. Bond yields, a 10-year bond was wavering to some extent. So it shows us that, it's not a perfect party. Things still look better than average, but things do not look perfect. 2015, bond yields moved from near zero up to around 50 basis points, half of 1%. The 10-year bond stays kind of flat, but notice the spread. If we were to calculate the spread between the 10-year and the 1-year, it stays pretty consistent. And that's what you want to see, is that even if the short-term bond yields are going up, the next question is, are the long-term bond yields going up by the same amount? Is the spread consistent? And more or less, yes, it is. And that shows us a strong economy. It shows us, yes, the Federal Reserve may start to raise rates, but the economy is still growing, so that's okay. Our interest rates might go up, but our salaries are also going up. Our car payment might go up, but our housing investment and our stock investments are going up. So apples to apples, we're still in a good situation. The stock market was wavering to some extent. A buy low, sell high approach still does work in this type of environment, though. It's okay that rates start to rise off the bottom on the short term as long as the long term is rising more or less at equal pace. That was the case in 2016 also. 1-year bond yields are rising, so are the 10-year. The stock market continues to go up. Buy low, sell high type of approach works very well as long as this spread remains consistent. 2017, that spread starts to narrow. The Federal Reserve is raising interest rates, but you see in 2017, the 10-year bond says, uh-oh, they're raising rates so much, it may start to slow the economy. That's why my outlook for the economy is not so great. I'm speaking as if I was a 10-year bond. The 10-year bond hit highs at what, 260, but closed the year on 240. So the anticipation for better growth in the future, it kind of waned a little bit. Why? Because the rates were starting to, the perception is they would start to cool the economy. The stock market's always late to the game, though. The S&P 500 started out the year on 2250. It ended the year 2700, and that's another lesson to be taken away from this. With stocks, you have time. Stocks usually, I don't want to say always, but usually react after the fact. The bond market is really going to tell us what the situation is on the ground. The stock market, and there's no accident why this occurs. The stock market moves in anticipation of future corporate earnings. How much will the corporations earn? Well, we don't know. We have to go to the stores. Let's see how much we spend. How much we spend is determined by other lagging indicators. How, whether I have a job, as far as my investments are concerned. And if stock investments are still going up, I'm still confident, I'm still going to go shopping. And that's why corporate earnings are delayed by nature. Well, in 2018, we see the 1-year bond really grew aggressively. Take a look at this. The spread in early 2018, the 10-year was paying 290, the 1-year was paying around 2%, 90 basis point spread. We closed the year almost with no spread, where the 10-year bond and 1-year bond almost were touching at that point. And by the way, when the long and short-term bonds all have the same yield, that's called a flat yield curve. It's an unusual situation, it doesn't last long, and it's usually a sign of something to come. Now, that was in 2018. The stock market started off on a strong note, but about three-quarters of the way through third quarter, the stock market started getting a lot of trouble. And this is 2018. This is far before anything we know about COVID. This is in 2018, the stock market and the economy already really started to waver. Notice a 10-year bond, the red line, really started to move down. We dropped from a 320 down to a 270 on the 10-year bond yields, coinciding with very weak stocks. 2019, 1-year bond goes down. in anticipation or in reaction to the Federal Reserve cutting rates. They actually were cutting rates prior to COVID. It wasn't a huge recession. I think this is probably the best example of a soft landing. If it were not for COVID, I think this really would have been a soft landing. The Federal Reserve would have cut rates. We would have hit some sort of soft bottom, and then the economy would have been back up to the upside if it were not for the COVID stock market crash. 10-year bond is moving down on the same note as a result of the expectation of lower economic conditions, poor economic conditions in the future. And notice a flat yield curve. Now I know the lines are going down, but at every moment when the 1-year bond is going down, the 10-year bond is going down almost to the same extent. They're basically matched at rates. So in March, they both had a 260 yield. In July, they both had a 2% yield. So that was a flat yield curve when these lines really mimic each other. And when you have a flat yield curve, well, the stock market, it hasn't even noticed yet. It's still going up in 2019. It says, hey, the yields are going down. Now, those of us out there paying attention to the bond market might have been a good time to take profits in the stock market with the S&P 500 near 3,200 by the end of 2019. Well, 2020 came to be, and of course, we know March in particular, COVID crisis, stock market crash, 1-year bond literally goes from 160 down to almost zero in a very short amount of time. The Federal Reserve drastically cut interest rates. The 10-year bond fell in anticipation of really bad economic conditions. Flights were canceled, hotels were closed, everything that went on at that time. And then we had a period of low interest rates from March 2020 on forward. Well, again, remember the lesson we learned from 2012, 2013, 14, 15. When you have zero interest rates, stock market, buy low, sell high. Because we know as long as we have zero rates, stocks and 10-year bond yields will eventually start to go back up. And that's exactly what we saw. Take a look at the low on the S&P 500 around 2200, March of 2020. We closed the year 3800. Low interest rates, great time for stocks. Well, this is 2021. For the most part, low interest rates. 2021 looks a lot like 2015. Low interest rates, and then the 1-year bond starts to find a little bit of a tick up. 10-year bond, it's not certain. It continues to increase slowly and in a very choppy manner. We started the 10-year bond yield at around 90 basis points. We closed about 140. Wasn't a great year for 10-year bond yields, but it did go up. The stock market was extremely confident. Again, when you have low interest rates, or even as interest rates start to rise, as long as the spread remains constant, it's a good environment for stocks. Stocks like when there's an equal or a consistent spread between the two long and short-term yields. 2022, we know what happened. The interest rates skyrocketed. 1-year bond from almost zero went to 5%. This was the fastest increase in interest rates maybe in history, at least in recent history. Well, stock market did not like that at all. The bond market, the 10-year bond yield went up. Now, I know in the past we've said the 10-year bond yield moved in anticipation. It goes up in anticipation of better economic conditions. That is true. But it also goes up in anticipation of higher interest rates. It's just unusual that interest rates usually don't move this quickly. But that's why the 10-year bond moved from a near almost, 170-ish to around 4% in the year 2022. And stocks certainly during that period of time wavered. S&P 500 fell from 4,800 down to around 3,900 in anticipation. And that is what you were referring to. The bear steepener, you're 100% correct. The bear steepener is that when you have the long-term bonds go up, and then you see, well, that tells us, hey, inflation. And it's going to be a lot more difficult and a lot more expensive to borrow money for corporations or for individuals that want to buy a home or finance something. That's the bear steepener. It's 100% correct. 2023, left-hand side, the 1-year bond is still going up in anticipation of higher interest rates. Uh, this past week's jobs numbers we're going to talk about a lot the Fed funds futures. This may have changed. And moving forward, we're going to spend a lot of time watching the 1 year bond. If this starts to move down, we could be entering the next phase. Not yet, but we're going to be watching it closely. But take a look at the lesson we learned in the past. The spread between the 1 year and 10-year yield. Well, there's two things going on here. It's the 1 and 10-year yield, but go back to the prior chart, the inverted bond markets. The inverted bond market is when the 1 year actually crosses above. And the inverted bond market is so special of an event. Why? Because it shows us the Federal Reserve is raising rates now faster than the expectation of future economics. Our anticipation for the long-term economy, not so great. Anticipation of higher rate interest rates, even more. And now we have a full-fledged inverted bond market at the deepest point. We had 150 basis point, a 1.5% spread between the short-term bond on top, the long-term bond at the bottom. It's usually opposite, right? Well, during that period of time, stocks wavered, and we see here the 10-year bond yield is continuing to go up. So, to go back to the original premise of the question, the bear steepener. Isn't that a bad thing? Isn't that a negative sign for the economy? Yes, it is. Because the 10-year bond yield moving up so much, it's anticipation, or I should say, it's in reaction to higher interest rate. Eventually, the 10-year bond will go down in anticipation of lower economic conditions. That may have actually already started at the end of last week. The 1 year bond is really the trigger. Now, in our prior FOMC Federal Reserve video, we said, well, 10-year bond yields are going up, and that's a good thing. When there's a contradiction. Well, both actually can be true for different reasons. Our Federal Reserve video, we're speaking in terms of the 10-year bond yields going up in the short term in anticipation the economy will be stronger, that the Federal Reserve maybe is at the end of their tightening cycle, and that the jobs numbers still look good, and the inflation's not so bad, and just not too long ago, GDP 4.9%, the best number we've seen in a long time. So in the short term, the 10-year bond yields were going up in anticipation of strong economic conditions. That was true at the time. Take into consideration the non-farm payrolls this past Friday, 150,000, one of the worst numbers we've seen in quite a while. The 10-year bond yields on the short term, yes, it did go up. I guess we have to differentiate between market action and the overall picture. In the market action, 10-year bond yields go up in anticipation of stronger economics. But over the long term, the 10-year bond going up shows to us there's a storm ahead of us. And that storm is higher interest rates, and that will eventually lean on the economy, put pressure on the economy, slow jobs down. I think we can see evidence of that in the last non-farm payroll number. So, what do we take away from this? Moving forward, what are we watching? So 1 year bond is number one. This is always our trigger. It's going to tell us what the Federal Reserve is most likely going to do in the future. And the signal we're really looking for is if the 1 year bond crosses back below the 10-year. And not that the 10-year crosses up above the one, that the 1 year crosses back below. Number two, are watching the 10-year because the 10-year is telling us our anticipation of long-term economic conditions. If that starts to go down, it tells us that the bond market and all those who participate in the bond market are thinking things don't look so good in the long-term future. The stock market, it's always late to the game. But I think based on what the bond market tells us, I think it's easy to deduce what our appropriate, position may be in the stock markets. And of course, we want to see how the markets react on the release of every single major economic report, and also take into consideration how does the market react as a result of the report? Bad number, does the market go down, or is it ignoring bad news? Good number, does the market go up, or is it ignoring good news? That always gives us a little bit more color as far as where the market may be headed next. So we thank you so much for the comment, and everybody else. We read every single comment. We really do, and it's given us a lot of great ideas. We have a huge pipeline of ideas. That's why you haven't seen it yet, but we promise we will get to it, down the road as well. We thank you for joining us. We look forward to seeing you back soon.